Despite the solid Q1, I think we all know that there's heightened uncertainty from trade policy, geopolitical tensions, and the evolving regulations are beginning to weigh on second quarter forecasts. Clients are lengthening decision cycles, holding discretionary budgets, and really reevaluating capital-intensive projects, particularly in industries like manufacturing, retail, automotive, and even financial services. So in this environment, for the first time in 90 indexes, we're really going to provide two distinct scenarios for our full year outlook. Let me kind of walk through these. So the first scenario is what we'll refer to as transitory tariffs. And in this scenario, we sort of expect a recovery in the second half of 2025. In the current tariff environment stabilizes by mid-year, so say, mid Q2, early Q3, we expect to return to stronger decision-making in the second half. And under this scenario, we would really see the as-a-service market to grow by 18% in 2025, which would be driven by AI, cloud, and consumption-based scaling. The managed services, we're going to reduce our forecast in this scenario from our original forecast of 4.5% to 1.3% annually. We think that delayed discretionary projects in Q2 and Q3 will be difficult to convert and grow on the backside of the year. This path reflects really a temporary market pause, not a shift in the enterprise intent or the global scale of the market. The second scenario is really a prolonged disruption or structural impact with tariffs. If the tariffs extend through Q3 and beyond, and especially if compounded by immigration enforcement with H-1Bs, prevailing wage issues, or retaliatory digital services taxes in the EU, we would anticipate a longer pullback in discretionary demand and a larger delay in award conversion. Under this more bearish case, taking a look at as a service, we would lower our forecast 300 basis points to 15% growth. So still strong growth. Again, that's going to be driven by the hyperscalers and the as a service. The managed services market we forecast would contract to negative 2.4%, or nearly a 700 basis point swing from our original 4.5% forecast. We remain cautious in our base case, but not pessimistic. The signals from Q1 are fundamentally strong. The shift we're seeing is not one of demand collapse, but really of delayed commitment. We'll continue to monitor these dynamics closely. For now, we remain cautious in our base case, but see meaningful upside potential if conditions begin to stabilize in the coming months. As always, we'll keep you up to date through the Index Insider and our sector briefings as new signals emerge.